A very good morning, friends. So we are almost on the last trail of the standards on consolidation. First, we covered the aspect of Ind AS 103 business combination, followed by Ind AS 110. And today we've got plethora of standards on consolidation, Ind AS 111 and Ind AS 28. I would not say Ind AS 27 is a part of the consolidation because it tackles the concept of separate financial statement. So we've got three agendas for the day. One is Ind AS 111, which talks on joint arrangements. Then Ind AS 28, which talks of investments in associate and joint ventures. And then we've got Ind AS 27, which talks about separate financial statements. Naturally, considering the relative importance, we're going to spend some good time on 111 and then followed by 28 and then 27, because 27 is a very small standard. So we'll just make a very quick chart on Ind AS 27 towards the end. So I guess let's start the journey in terms of Ind AS 111, which talks about the concept of joint arrangements. First of all, to recall, if you remember, when we started the journey in terms of Ind AS 103, I'd given you a three-step model at the very start where I gave you the permutation combinations when different standards would apply. And if you recall, I had said that if there is a situation of control, the standards which trigger is 27, 103, and 110. If it comes to a case of a joint control, then it is 27 and 111. When it comes to a significant influence, it is 27 and 28. And if it is a case of a passive investment, then it is Ind AS 109. Because if you've got investments in related parties, then the concept of Ind AS 27 is applicable. So let's come to the concept of a joint control where Ind AS 111 would trigger. Now, when I look at Ind AS 111, the name of the standard is joint arrangements. The name of the standard is joint arrangements. And as I look at this particular standard, three aspects comes to my mind. I know you must be wondering at times, why does only three steps and three issues comes to your mind? I think just by chance, I would say. So when I look at the entire Ind AS 111 for an understanding, there are a total of three issues which are addressed in the standard. So let's first look at what are the three issues which are addressed in the standard. I would say the issue number one. So making a list of the issues because we'll discuss these issues one by one. And of course, for a detailed input, please refer the detailed lectures of the previous batch where you're going to get some detailed insight on all these issues. Of course, today we're going to just have a little overview in terms of the technical inputs related to these issues. The first issue which is addressed in the standard is that how do you identify that it is supposed to be a joint arrangement? Because this standard would trigger only and only if it is supposed to be a joint arrangement. So we need to first of all have a look at that if it is a case of a joint arrangement, when do you say it is a JA, a joint arrangement? The second issue which comes up in the mind is once you've identified, yes, it is a joint arrangement, we need to consider that what is the type of the joint arrangement. So when I say the type of the joint arrangement, the standard very clearly brings out that there are two kinds of joint arrangement. One is called a JO, that's a joint operation, and one is called a JV, that is a joint venture. So we need to basically take a call in terms of that whether it is a case of JO or whether it's a case of JV. I think it's worth making a mention at this particular stage that if it is a case of a joint operation, the accounting of the joint operation, of course, is covered in terms of this standard itself. That means under 111. But the moment you say that it becomes a joint venture, the accounting of this joint venture moves out of the standard and we are supposed to apply Ind AS 28. So that's another crucial point we need to keep in mind that once you identify the type of the joint arrangement, if it is a joint operation, the accounting is covered under 111. But if it becomes a joint venture, you basically push the things out and you go to Ind AS 28. That means Ind AS 111 directs you to the concept of Ind AS 28 when it becomes a case of JV. And then, of course, considering the accounting, the third issue what we need to keep in mind is the accounting of a joint operation in terms of, you can say, separate as well as consolidated financial statements. So how would the accounting take place in a separate and in a consolidated financial statements? So at the very start of the standard, your mind needs to be very clear that there are going to be a total of 3 agendas we're going to discuss. So I'm going to carry forward the journey in terms of each of these issues in the same sequential order. We're going to first of all learn the art of identifying whether an arrangement is a JA, and then the type of the joint arrangement, JO or a JV, and then finally the accounting of a joint operation in the separate and the consolidated financial statements of the investor. So I think with this inputs in hand, let's go further and let's start the journey in terms of issue number 1. So as I said, the very first issue is looking at the parameters on the basis of which you would decide that is it supposed to be a joint arrangement or not. Now I'm going to make a very simple 3-step model based on the issue number 1, which will help us to identify whether an arrangement is a JA. So let's, I think, have a look at in terms of the 3 parameters. So we've got a step number 1. At the first step, I will put across a question that is it a CA, not a chartered accountant. You're looking at is it a CA? That means is there a contractual arrangement? So the first step is looking at whether there is a contractual arrangement. So the first aspect is looking at is there a CA, that is a contractual arrangement. I guess let me quickly also give you insight on what a contractual arrangement is. When you look at a joint arrangement, one thing is very clear. There will be 2 parties or maybe more than 2 parties which are, coming together and they enter into a contractual arrangement. That means they enter into an agreement which could be oral or which could be a written agreement, and they decide that they are going to act together. So when you look at the concept of a contractual arrangement, I would say a contractual arrangement means that we're looking at the presence of an agreement, which I've already said could be oral or which could be a written agreement. And under this agreement, you've got 2 or more than 2 parties. So you've got 2 or more than 2 parties are there who have agreed to act together. So in this particular case, we can say a contractual arrangement would be indicative when 2 or more than 2 parties have entered into a formal agreement, maybe in oral or writing, that they are going to act together. That is step number 1. And then we go on to the step number 2. The step number 2 as well as the step number 3, both the steps are in terms of making the assessment whether there is a joint control. So basically you need to see in terms of step 1, is there a CA? And then in terms of step number 2 and 3, a JC. So a joint control is what you're going to see in terms of both step number 2 as well as in terms of step 3. So remember, the step number 2 is also devoted to assessment of joint control. And even the step number 3 is devoted to the concept of a joint control. Now, when you say there is a joint control, there are 2 elements of a joint control. One is called CC. I'm interested in putting some interesting short forms in this particular standard. CC stands for what we call a collective control. So CC stands for what we call a collective control. So we'll take a quick look also in terms of what is a collective control. And then there should be UC in the third step, and that is what we call unanimous consent. And that is what we call a unanimous consent. And life becomes quite simple, when you start looking at a procedure on a step-by-step basis. So joint control is got two elements. One is the concept of a CC, that is a collective control, and one is a concept of UC, that is a unanimous consent. Now, I think let's understand the thin line of distinction between a collective control and the concept of a unanimous consent. Let's put it like this. I cannot take a decision alone. Mind the words carefully. I cannot take a decision alone. That means I am a part of the collective control. So if I were in a position to take decisions all over, all alone, without having the intervention of any other parties, any other investors, then I can say I've got a control. So if it means that I am not in a position to take independent decisions alone, I'm a part of the collective control. At the same time, when I look at the concept of a unanimous consent, it means that even other investors cannot take decisions without me. Remember, there are two aspects of a joint control. One is you're looking from your point of view, and the other is you're looking from the other investor's point of view. Mind it. So when you're looking at a joint control, the perception is one you're looking at from your perspective, and the other you're looking from the other investor's perspective. When I'm looking at my perception, I'm looking at whether I can take decisions alone or not. If I cannot take decisions alone, I am a part of the collective control. That means I have a dependency on the other investors, that unless they agree, I cannot take a decision alone. But at the same time, I also need to see the other party, that they also can't take decisions without me. So every decision needs a unanimous consent. So I am dependent upon them, that if they agree, then only I can take decisions. And they are also dependent upon me. If I don't give a consent, they can't take decisions as well. So you're looking at both the sides of the coin. So I would put it like this, that when you're looking in terms of a collective control, I will put a question to myself. So when I'm looking at a collective control, I'm going to put a question to myself: can I take decisions alone? Can I take decisions alone? So in this particular case, when I put across the question that can I take decisions alone, the answer should be a no. Then only I will be in a position to say that yes, I am a part of the collective control. So immediately when I put that question, can I take decisions alone? I say, no, I cannot take decisions alone. Then I am a part of the collective control. Because if you can take decisions all on your own, then you basically got a control, then Ind AS 110 would trigger. Similarly, when I'm going to look at the concept of a unanimous consent, I'm going to put a question to myself: can I block the decisions of other investors or not? Because as I said, you need to look at the two facets of the transaction. One is in terms of I cannot take a decision alone. And then the second aspect also, that they cannot take decisions without me. So in this particular case, the focus point in terms of the unanimous consent is that other investors, or rather, I'll put it like this, that I can block decisions. The question is, can I block decisions? So can I block decisions by other investors? That's a very crucial question to put across, that can I block the decisions by other investors in this particular case? And the answer which should come, it should be a yes. I should be putting an answer, yes, I can certainly block the decision. So once you're able to prove the concept of CA, that is contractual arrangement, then CC, that is collective control, and a UC, that is a unanimous consent, I will be able to prove that yes, it is supposed to be a joint arrangement. So I think let's take some quick examples on the situations of two parties. and also on the situations of three parties where we can quickly have a look at whether there is a presence of a JC. And all the examples, I am assuming very carefully that let's assume there is a contractual arrangement. So I'm going to assume in all the examples that yes, there is a contractual arrangement. I am only looking at the fact of assessment of a JC. So let's make an interesting chart to you. Now, this is going to be a very interesting chart because I am practically taking almost all the permutations and combinations in terms of taking a decision, a call. So as I said, let's take the examples in terms of two blocks. One is a case where there are two parties. So let's take a case where there are two parties. And then we'll consider the situation when there are more than two parties. We'll take three. So where there are more than two parties, so we'll take a combination where they've got three parties. And again, I am saying, I'm of course assuming a contractual arrangement. I'm only working on the assessment of a joint control in these combination. And then there is something more which I will tell you after this particular chart. Because when you're looking at the assessment of a joint control, there could be two broader kinds of questions. We'll come to that later. Now let's consider that there are two parties A and B. Let's take some different permutation combinations in this case. Number one, let's assume that each of the party has got a 50% stake in the voting power. In this particular chart, my presumption is that the decisions are going to be taken on the basis of voting power. Can the decisions be taken on other than a voting power basis? Yes. Like for example, there is a possibility that decisions are taken by the board of director. So in those particular cases, the presence of a joint control is going to be seen on the basis of how many directors do you have on the board. Because at the end of the day, if you've got as many directors that they can block decisions and they also got a collective, control over the board, then only a joint control would arise. So in this particular case, our basis of assessment is supposed to be the voting power. So as I just said a little while back, that there could be, two kinds of questions which could be given in the exams. One is the assessment of a joint control on the basis of voting power. And one could be on the basis of the composition of the board of directors because the decisions are being taken by the board of directors itself. So in this particular chart, my focus is that the decisions are going to be taken on the basis of voting power. Now come back. So we can say, let's assume that A and B has got a 50% stake. Now watch this. Let's take two combinations. Let's say I am clearly stated that A and B can take decisions only when they reach a majority. Unless they reach a majority, they cannot take decisions. Or let's say I define a certain percentage and I said that I need at least 75% majority to agree. So there could be two permutation combinations when there are two parties with an equal percentage. I say that, we need a majority. When I say majority, it means more than 50. Or I define a percentage that I need a 75% majority to take decisions. Now you would easily agree with me on this front, that in both the cases, I would say there is definitely a joint control. Put across the two questions to yourself and you'll get the answer. Let's put the first question. Can A take decisions alone? The answer is no. Can B take decisions alone? The answer is no. As we said that we need to have a collective control. Am I in a position to take decisions independently as an investor? So A cannot take decisions alone because majority is required. B cannot take decisions alone. And at the same time, can A block decisions taken by B? Yes. Can B block decisions taken by A? Yes. So I would say both the elements are present. As an investor, he cannot take a decision alone. That's one. As an investor, I'm not in a position, I'm in a position to block the decisions taken by the other investor. So it is always, I would say, a case of implied joint control, undoubtedly implied joint control. If you notice in this particular case, what I have done, I have taken equal percentages by the two investor. Let's take a situation where we've got an unequal percentages which are held by the investor. I'm trying to look at all the permutation combinations for a better clarity of thoughts. So let's now consider the same situation where A and B, let's say, have got unequal percentages. So let's say A has got 60% stake and let's say B has got a 40% stake. And let's again consider the two combinations. Let's say we need a majority to take a decision. Or let's say, for example, we need a 75% to take a decision. Now let's have a look and decide, is it possible that there is a joint control? Now we need to be careful in this case. If you notice in the very first case, we can say, I need a majority to take a decision. A has got 60%. He's already in a majority. Put the question to yourself that is A as an investor in a position to take decisions alone? Yes, he is. And if you remember, as I said earlier, can I take decisions alone? If you say no, then you go to the second question. If you say, yes, I can take decisions alone, you've got a control in this particular case. So I would say in this particular case, when it is a majority, it is a case of control by the investor A. But if you look at the other combination, that is 75%, now put the same questions to yourself. Can A take a decisions alone? No. Can B take a decisions alone? No. Can A block the decisions taken by B or B block the decisions taken by A? I would say yes. Both the factors need to be present. I cannot take a decision alone. That's my perception. The other people can't take decisions without me because I'm in a position to block their decisions. So it is most important. I know you must be thinking, so give us an example where you cannot take decisions alone, but other people can take decisions without you. You are not in a position to block decisions. Coming soon in terms of this combination. So we'll come to that input as well, where you can say, I cannot take decisions alone, true, but people can take decisions without me. That's also true. So then a joint control would not arise. So in the second combination, of course, we can say a joint control is undoubtedly implied. So let me, I think, say something at this end, which is very visible at this stage. And I think I want to put that point, across deeply. Just look at the inputs that if A and B have got an equal percentage, I think it is always a joint control. And if A and B have got unequal percentages, you will have to make an assessment. There could be a control or a joint control. So moral of the story is very simple, that if you've got two investors with equal percentages and you need to take decisions on majority or a defined percentage, I think it is always a JC. And if you've got two people with different percentages, then depending upon what kind of situation you are, you want a majority or you want a certain specified percentage, there could be a control or a joint control. Simple. That is one input. Now let's come to the situation where there are more than two parties. So let's take a case of, let's say, three party. So let's consider A, B, and C. And let's consider A has got 50% and let's say B has got 30% and let's say C has got a 20%, and let's consider we need let's say not a majority, but let's define 75%. So let's say to take decisions we need 75% consent of the investors. Now let's put the question to ourselves. Can A take decisions alone or B or C take decisions alone? No, they cannot. Individually, they cannot achieve a 75% result. So A or B or C cannot take independent decisions. But now let's look at the other important question. If B and C join together, mind it carefully, if B and C join together, can A block decisions? Yes. If A and C join together, can B block decisions? Yes, because they will get only 70%. And the other combination is, let's say if A and B join together, do you think C can block a decision? No. Because if A and B join together, they get an 80% combination. C is not in a position to block decision. So the interesting part in this case is, if you look at things from the C's point of view, can he take decisions alone? The answer is no. Can he block decisions taken by A and B put together? The answer is no. Poor fellow has got no joint control. So what does this mean now? That if the joint control is there, we are saying that the joint control is between A and B, and C is not a party to the joint control? Yes. You'll have to apply Ind AS 28 in terms of C to make an assessment whether he has got a significant influence or not. Because if you remember, in Ind AS 103 also, I very categorically said that when you're looking in terms of assessment of the investor, you need to see control, if not a joint control, if not a significant influence, if not, then a passive investment. So we need to look at the relationship of the investor in a very sequential manner. Ind AS 110 also very clearly says that irrespective of the involvement with the investee, you should always first look at whether I have a control over the investee or not. So you need to first look at the control, if not a joint control, if not a significant influence, if not a passive investment, which means in this particular example, I would clearly say that as far as C is concerned, you need to assess a significant influence for investor C. If he gets a significant influence, he would apply Ind AS 28, and if not, then he becomes a passive investor. But something interesting to watch, which I will come to that later as well towards the end of the chart. In this case, if A and B are having a joint control, and let's say it becomes a JV, let's say the arrangement becomes a JV, even A and B would apply Ind AS 28. And in this particular case, if C has got a significant influence, he would also apply Ind AS 28. Which means whether you've got a joint control or you've got a significant influence and the joint control turns out to be a joint venture, you are still under Ind AS 28. The accounting which A, B, and C would apply, provided it is a JV, is going to be the same. That's interesting indeed. We'll make those interesting charts later. Especially when I kick off that Ind AS 28, I'll give you those permutation combinations in terms of which standard triggers, in terms of separate, and in terms of consolidated financial statements, and various permutation combinations to watch. Let's make another combination. Let's consider now again the case of three investors. Let's say this time it is 50, 25%, and let's say 25%. Now that's an interesting one to watch. In this particular case, let's say we need to take decisions on the basis of, let's say, a defined percentage, that is 75%. Now, if you look at the interesting part, put across the two questions again to yourself. Can A take decisions alone? No. Can B or C take decisions alone? No. Now let's see, can A, B, or C block decisions? If let's say A and B joined hands together, or rather let's first take, is B and C join hands together, can A block decisions? Yes. B and C cannot achieve 75%. Let's say if A and B joined hands together, can C block decisions? Unfortunately, no. If A and C join hands together, can B block decisions? Unfortunately, no. Which means that if A and C join, B cannot block decisions. If A and C join, B cannot block decisions. So B or C may not be able to block decisions, but that's only, there are two combinations. If A and B joins, then C cannot block decisions. If A and C join, then B cannot block decision. Now, there is something very interesting which is given in the standard. It says when you've got two combinations or more than two combinations giving a joint control. In this case, I would say A and B is one and A and C is another combination. If two or more than two combinations gives you a joint control, what is most important is the contractual agreement should clearly mention which combination is to be considered for a joint control. And interestingly, if the contractual arrangement does not make a mention, if the contractual arrangement does not make a mention that which particular combination is going to work, in that particular case, none of the parties have got a joint control. I put that again, that's a very important input. The standard has made one thing very, very clear indeed, and it says that if there is two or more combinations coming in, if there are two or more combinations which will give you a joint control, you need to write it in the agreement which combination is going to be considered. So there should be, you can say, a written documentation. It should be clearly written in the agreement that for the purpose of joint control, which combination is going to be considered, A and B or A and C. If the agreement is not there, if they have not written in the contractual agreement which combination works, none of the parties ABC will have a joint control. They'll all have to apply the concept of significant influence assessment. So if there is no written agreement, nobody is got a joint control. So if there is no written agreement, if there is no written agreement, either ABC, nobody has got a joint control in this particular case. None of them will be able to apply Ind AS 111 in this particular case. Wow, that's interesting. Though this is not very clearly written in the standard, but if you look at the interpretations which comes out of this, it is very clear that none of the parties would be able to apply Ind AS 111 in that case. So moral of the story, if you've got more than two parties, you'll have to put across the same two questions whether they can take decisions alone or not, and whether they can block the decisions taken by the other investors. If you say, I cannot take decisions, one, I can definitely block decisions, yes, then you are a party to the joint control. So in one of the examples, we saw that C cannot take decisions alone, but at the same time, he cannot block the decisions taken by A and B. So he is not having any joint control. You go and assess a significant influence in his case. I hope so far so good. Let me just quickly have a look. Any questions coming in so far? Okay, I think all good to go. So I think we've answered the first issue to you. So as I said, the standard is divided in a total of three phases. So the first phase is answered that in this particular case, when you look at a joint arrangement, you're going to look at CA, CC, and a UC. Now, as I said, there can be two kinds of questions where the concept of joint control assessments might be required. So as I said, we'll look at those two kinds of questions. So I would say when you're looking at the assessment of a joint control, when you're looking at the assessment of a joint control, I would say that you can see two categories of questions which are given in the study material as well. And I would say the assessment of a joint control is supposed to be dependent upon, you can say, two kinds of factors, independently, of course. One is that we are considering the voting power. We are considering the voting power as a base to make assessment. And the other one is that we're looking at the composition of the board of directors, BOD. So I would say there are two inputs what we're looking at. So when you look at the question for the assessment of a joint control, first look at the fact. What is the basis of taking decisions in the joint arrangement? Is the decisions being taken on the basis of majority voting rights? Or is the decisions being taken by the board of directors? Now, what we have done in the chart above, what we have done in the chart earlier, the chart what I gave you, previously, This is going to be applicable in terms of a situation when the voting power becomes a base. Well, let's say, for example, we are not considering a voting power, but we're looking at the composition of board of directors. Let's take an example. So let's say there are two investors, A and B. And let's consider that in the arrangement, 4 directors are to be appointed. So we can say the number of directors which A can appoint is 2. The number of directors which B can appoint is 2. They can appoint 2 directors each. And I say decisions are to be taken on the basis of majority board of directors. You put across the same question to yourself in this case. Can A take a decision alone? No. Can B take a decision alone? No. Can A block the decisions by B or B block the decisions by A? The answer is again yes. Since they can appoint equal number of directors, then we can say it definitely implies a joint control. Now, the interesting part to watch in this kind of combination is that let's say even if you look at a voting power, let's say they can appoint 2 directors each, but if I look at the voting power, let's say he's got a 60% stake and he's got a 40% voting power. So this is, let's say, the voting power. Since the basis of taking a decision is the board of director, since the basis of taking a decision is board of director, it doesn't make a difference to me what is the percentage of voting power. So this voting power is going to be something which is irrelevant in terms of deciding who has got a joint control. So irrespective of the percentage, because sometimes the question might give you an information where you see that on the basis of voting power, A has got a control. And on the basis of board of directors, they've got a joint control. But since the basis of taking a decision is the board of directors, the percentages becomes irrelevant to decide the criteria. Some more inputs sometimes you can see in this particular case. Let's say, for example, the question gives you the input in the same situation. Let's say in the same situation, the question gives you another input. A and B can appoint 2 directors each. But in this case, I'm also given that let's say the chairman of the board of director, the chairman has got, let's say, a casting vote. So in this particular case, the chairman has got a casting vote. That means if there is a tie in terms of decision, the chairman has got a casting vote in this particular case. Now, in this particular case, if the chairman has got a casting vote, and let's say I say that chairman is to be appointed by A. So if I say the chairman is appointed by A, then in that particular case, I would say that A gets a control. Because in this particular case, let's say, for example, if you're looking at a situation that out of the 2 investors, one of the investors will be a chairman of the board and he's got a casting vote. That means whose things will be prominently. The chairman would be the decision maker. So in that particular case, you would consider a case of control. So these are broadly the 2 kinds of questions you can see. And sometimes, of course, the focus may shift in terms of, assessment of a voting power or assessment in terms of board of directors, but they may start asking you the assessment in terms of relevant activities. Because remember, there is one more crucial aspect which you need to keep in mind. That the parties which are having a joint control, they need to be in a position to take a collective control and unanimous consent on the relevant activities. So there is a possibility, just like in terms of Ind AS 110, in terms of Ind AS 111 as well, that, in a given point of time, there might be a different control by one investor. There may be a different joint control by one set of investor. Because the relevant activities could also be important. So you can have a look over those detailed videos, what we've covered earlier, where we've talked in terms of the relevant activities as well. Okay, so far so good. I guess let me just come back on the agenda. I think we've covered the very first issue with you, that is identifying a joint arrangement. I think now we know very well that once you're looking at a joint arrangement, your focus needs to be clear that in terms of the joint arrangement, you're looking at three steps. Is there a CA? Is there a CC? And is there a UC? And you need to be clear in terms of assessment is taken voting power based or assessment is taken on the basis of the composition of the board of directors, because either decisions are taken on the basis of voting rights or the decisions are taken by the board of directors. And accordingly, we need to see that the investors have a majority composition of the board or they've got majority voting rights, whatever. Now let's come to the second agenda, the issue number 2, what we're looking at. Now, in terms of the second issue, in terms of the issue number 2, where we're looking at the type of joint arrangement. The second agenda, what we're looking at is the type of the joint arrangement, where we said very clearly that we need to decide, is it a JO or is it a GV, a joint operation, or is it a joint venture? Now, before we consider the classification and before we apply a simple three-step model here again. So here again, a three-step model. Yes, we've got another three-step model in the step number 2 as well. But before you look at a three-step model, what do you need to do? You need to first of all put across a simple question to yourself that did we create a separate vehicle? Did we create a separate vehicle? So the first question what you need to put across to yourself is, did we create a separate vehicle for the purpose of this arrangement? So what do you need to put across is that A and B together, did they create a separate entity C? Or did A and B decided, no, they're not going to create a separate entity? So the first question, the very first question which you need to put across is, did we create a separate vehicle or not? Now, when you say, did we create a separate vehicle? The answer is either a yes or the answer is either a no. So either we say, yes, we created a separate vehicle, or no, we did not create a separate vehicle. The standard is very clear on the agenda that if you have not created a separate vehicle, if you have not created a separate vehicle, it is undoubtedly a joint operation, decision taken. But if you say you've created a separate vehicle, it can be a JV, it can be a JO. In this particular case, we're going to apply a simple three-step model again. So remember, in the second issue, when you're looking in terms of deciding the category, the type of a joint arrangement, before you apply a three-step, your focus is, did we create a separate vehicle or not? So if a separate vehicle is not created, two parties join hands together without creating a separate entity, without creating a separate vehicle, it is undoubtedly a joint operation. But if you create a separate vehicle, you need to make an assessment under a three-step model. It could turn out to be a JV, it could turn out to be a JO. Now here we've got some interesting inputs for discussion. And watch this carefully as I give you the nitty-gritties in terms of the three steps to decide the category. So let's have a look at the three-step model. So when you created a separate vehicle, we've got step 1, we've got step 2, and we've got step 3. Now, at the first instance, many students go wrong in this particular assessment. So it is important before we get into these 3 steps, let's understand what is the sequence in which the steps are applied. So get this very clear. The first is that we need to look at a legal form. The first one is that we need to look at a legal form of the entity. We need to look at the legal form of the separate vehicle. Now, when you create a separate vehicle, there could be various forms in which a separate vehicle is created. So I would say you might have created, for example, an LLP, or you might have created, let's say, for example, a normal partnership firm, or you might have created, let's say, a company form of organization. I remember there is a very interesting Ind AS bulletin which was, clarifying this agenda in terms of the legal form of the separate vehicle. So when you look at a separate vehicle, you either organize it as a limited liability partnership, or you organize it as a normal partnership firm, or you organize it as a company. The basic thought process in terms of the legal form is you are making an assessment of what we can say separate legal entity. We're making an assessment of what we can say is a separate legal entity concept. Now, watch this carefully. When you create a company, for example, you can say investors and you can say the company are separate legal entity. The owners and the company can be identified as separate legal entity. So there is a split. So the moment you say that you've created a company, a separate legal entity is established. The moment you create an LLP, a separate legal entity is established. If you can prove that a separate legal entity is getting established, then it is a joint venture. I would also call it, for the ease of understanding, I always call this legal form as a litmus test. I put that as a litmus test. Don't write that in the exam. This is only for your understanding perspective. I call it as a litmus test. On the very apparent front, just see, when you created a separate vehicle, did you create a company? Did you create an LLP, which ensures a separate legal entity between the investors and the company or the LLP? Then it is supposed to be a JV. But in terms of a firm, a separate legal entity is not established. A separate legal entity doesn't get established. So when you're looking at that, you're creating a partnership firm, you can say the partners and the firm, they're not supposed to be separate legal entity because they're jointly and severally liable. So in this case, it becomes a GO. Now, why do I call it as a litmus test? Irrespective of whatever you've decided, you need to go to step 2. I'll make an interesting chart and give you some good permutation combinations on this 3-step once we're done with this 3-step. So on the very front, I would say your very first focus point should be to see that when you created a separate vehicle, is it a company, LLP? Is it a company or LLP, JV? Is it a partnership firm, JO? So irrespective, you will go to step 2. Whatever decisions you've taken, you need to still go to the step number 2. Now, what do you do in terms of the step number 2? In terms of step number 2, you need to look at the terms of contractual arrangement. You need to look at the terms of the contractual arrangement. So we need to evaluate the terms of the contractual arrangement in this case. Have the investors, through a contractual arrangement, try to override the spirit of the joint operation or a joint venture? So I would say, in simple words, by the terms of the contractual arrangement, are they trying to dilute the legal form of the entity or not? You create a firm, but you are basically running it like a company form of organization. You create a company or LLP, but you're running it more like a partnership firm. So we can say it is something, what I call it as that you are trying to disguise the entire arrangement. You're trying to, disguise the entire arrangement. It's like, for example, on the face of it, it looks like something different, but when you start looking at the substance over the legal form, so this is more like looking at the substance over the legal form. So that is why I call the step number 1 as a litmus test, because it will only tell you on a very apparent level that yes, considering the legal form of the entity, it is, ensuring a separate legal entity or not, and you decide a JV or JO, but you need to dig further. The standard has got a clear-cut focus that you need to dig further. So this terms of the contractual arrangement is like looking at substance over legal form. It is looking at, you can say, a substance over the legal form. So you've already seen the legal form in step number one, but now what you need to do in this particular case, you need to look at the contractual terms. Now, there are two possibilities which could arise in terms of the contractual term. One is that the terms are completely silent. If the terms are completely silent, it's time to go to step three. If the terms of the arrangement is completely silent, it's time to go to the step number three. And if the terms are there, in that particular case, we need to make an evaluation. And what kind of evaluation we'll do? Watch out. By the contractual terms, are the investor getting share in the net profit, net assets? Or are they getting a share in the asset, obligations towards liability, and you can say share in the income and the share in the expense? So there are two possibilities. The two possibilities are that they are getting a share in the net assets and the net profit. They are getting a share in the net assets and the net profit, or we can say they are getting a share in the asset, obligation towards liability, and share in the incomes and the expenses. So this will be very clearly stated in the case study that, the investors, the parties to the arrangement, have agreed that they will get either a share in the net assets or net profit, or they get a share in the assets, obligations towards liability, a share in the incomes and expense. Now, in this particular case, if they are getting a share in the net assets and net profit, it is a JV. And if they're getting a share in the assets, liability, income and expense, it is JO. I know there is another $1 million question coming to the mind. And the $1 million question, what is coming to the mind is that why did you look at step number one if your step number two is going to have an overriding effect? Because indirectly, you are looking at the step number two and taking a call. So why did we even look at a step number one if step number two will override the decisions taken in step number one? Well, what happens if the step number two is silent? Then the decisions are being taken practically by step number one. And let's say even the step number three is silent, then your entire decisions is dependent upon the litmus test only, which means step number one will be relevant. Mind it. Step number one will be relevant only when the step two is silent and the step three, which I'm going to tell you, is silent. So indirectly, your step two overrides step one, your step three overrides step one. Mind it. The step number two overrides step one, the step number three overrides the step number one, and the step number one is relevant only when there is no inputs in terms of step two and three. We'll give you that interesting chart after the end of the discussion. So, as we said, first look at the apparent legal form, that is a litmus test. See what kind of separate vehicle is created, what is the legal form. If it is a company or it is supposed to be LLP, JV. If it is a firm, it is JO. Then you go and look at the substance of the legal form. By the contractual arrangements, have the investors tried to dilute the spirit of the legal form? If they say that they want the share in the net assets, net profit, it is like running like a company, then it is a JV. And if they say that they are going to get a share in the assets and obligation towards liability in disproportionate percentages, I want a 80% stake in the assets, I will take only 60% stake in the liability. So I'm getting a disproportionate share in the assets and liability. Then it's more like a firm, it's a joint operation. Now remember, if the contractual terms are there, you are decided, I don't need to go to step three. So let me pinpoint, in this case, there is no need to go to the step number three. It is only when the second step is silent, you go to the step number three. And in terms of the step number three, what I need to do, I need to look at the other facts and circumstances. I need to look at the other fact and circumstances and decide whether it is a JV or a JO. Even you can say that this step is also looking at the substance of the legal form. So either step 2 overrides step 1 or step 3 overrides the step number 1. You are going to look at other facts and circumstances, which could be indicative that it is a JV or it's a JU. We'll talk of the third step also. So I think, well, let's have a quick look first of all on the sequential order in which we need to apply these particular steps. The first is you look at the legal form and you decide it's a JV or it's a JU. Irrespective, you go to step 2. Irrespective, you go to step 2. Whatever decisions you've taken in step 1, you go to step 2. In terms of step number 2, you decide based on the contractual terms, it's a JV or a JU. Now, step 2 is going to override step 1. If you decided it's a JO in step 1 and you decide it's a JV in step number 2, step 2 prevails. If you decided JO, of course, JO. Step 2 is going to override and take a decision. If the inputs in step number 2 is silent, we need to see step number 3. Is there any facts and circumstances which contradicts the step number 1? Which means if there is no inputs in step 2, there is no inputs in step 3, then whatever step 1 decides is the answer. But if step number 2 information is there, it overrides 1. If step 2 information is not there, you go to step 3 overrides step 1. So whatever decisions will come from step number 2. If step 2 info is there, step 3 if 2 is silent and 3 is there, and step 1 if 2 and 3 are silent. Let's consolidate this. But before that, let's have a look at the other facts and circumstances as well. There is an interesting example which is given in the standard and which illustrates the concept of other facts and circumstances. So I will just give you insights on the other facts and circumstances. How interestingly, the facts and circumstances could indicate a contradiction in terms of step 1. Now, watch this example very carefully. It's one of the examples which is given in the standard 111 itself. Let's say, for example, there are two parties to the arrangement, A and B, and they created a separate vehicle. Yes. So there are two parties to the arrangement and they created a separate vehicle. Yes. So what I did, I said, let me apply my 3-step model in this case. I went to the step number 1 and I said the separate vehicle is created as a company, which means it is a joint venture. I went to the step number 2 thereafter, irrespective of the particular step, and I said, is there any terms, contractual arrangement terms? I said it is completely silent. I said, no worry, let's go to the step number 3 as well. I said, let's go to the step number 3 as well. So you can see the sequence in which we are deciding things. Did we create a separate vehicle? Yes, we did. We applied the 3-step model. We created a company form of organization, JV. The terms of the contractual arrangement, silent. We look at the other facts and circumstances. So we said, let's have a look at the other facts and circumstances. Now let's see what other facts and circumstances are given in this particular case. Now watch the facts. Now watch the facts in this particular case. Now, in this particular arrangement, the parties decided that 100% output. They decided that 100% output of C is for captive consumption of A and B. So as per their running of the entity, they decided that 100% of the output is for the captive consumption of A and B. So whatever the entity separate vehicle C is producing, that is not meant to be sold to outsiders. So no third party sale. There is no third party sale. So this is one input which is given to us, that there is no third party sale, and another inputs which is given to me. We'll analyze these inputs as well. But let's say we are given the input that 100% output of the entity C is meant for the captive consumption of A and B. They've not allowed entity C to make any external sale, any third party sale. The prices which have been fixed up, for the purposes of this output is supposed to be cost to cost. It is supposed to be cost to cost so that we can say that this entity C just does a break even. So they've decided to pass on the output to A and B in such a way that A and B will give that much money, which will only ensure a break even to C. They're not getting any profit margin. So these are the two inputs which are given to us. Now we need to make some analysis based on this input and decide what does these two inputs indirectly indicate. Now, hear this carefully, the kind of analysis which you are required to make on step number 3. When you say the 100% output is meant for the captive consumption of A and B, what does the output of entity C represent? The output of entity C represents, you can say, the future economic benefits. The entire output of entity C represents the future economic benefits of that entity. So whatever economic benefits, whatever output will arise from this particular entity, that entire future economic benefit belongs to A and B. And you know what is a future economic benefit? Future economic benefit is synonymous with the term assets. Because when you say that there are assets in the balance sheet will always generate future economic benefits. So when A and B in the arrangement decided that the entire output goes to A and B, it means the entire future economic benefits goes to A and B. It means indirectly the entire assets belongs to A and B in a given proportion. So passing on the 100% output is like passing on the future economic benefits. And trust me, I would say that future economic benefits, the name is assets. Remembering the Shakespearean language, when you're looking in terms of the future economic benefits, when you say that there are future economic benefits, the future economic benefits are what we can say represents the asset. So by passing on the output to the parties to the arrangement, they are indirectly passing on the assets in a certain proportion to the parties. Next, it says that these parties are being given the things at prices which is cost to cost. So now imagine if the prices fixed up in the arrangement is such that, C is only going to do a break even. Poor entity C is totally dependent upon the funds provided by A and B. Which means in order to meet his expenses and obligations, that is liability, he is dependent upon A and B because he doesn't get a profit margin on these particular output transfer. So in this particular case, if the obligations of C, because A and B are pumping the money to C and C is dependent upon the obligations to be met by A and B. So when I look at the prices are fixed in such a way, we can say the obligations or we can say the liabilities indirectly are met by A and B. Wow, what an analysis. So the entire setup of the arrangement indicates that if C will give it on cost to cost, that means he is dependent upon A and B for the obligations, liabilities to be met in that proportion. If C is going to give the entire output to the A and B, his entire output means the economic benefits, which is the assets. So passing on the entire output is giving the assets to A and B and giving them at a prices which is giving a break-even point is like being dependent upon liabilities to be met by them. So which means, are these parties getting a share in the assets and the obligations towards liability? Yes. If they're getting a share in the assets and obligations towards liability rather than net assets, we can say the other facts and circumstances is indicating that it is a JO. So, moral of the story, even if you've decided as per step one, it is a JV, you are going to call it as a JO based on the facts and circumstance. I think now it's very important to give you a very interesting chart like step number one, where you can see the permutation combinations of flow and get more clarity on thoughts. Let's make an interesting chart. This is going to give you more power. This is going to give you more insight in terms of taking decision. So we're looking at the three-step model, step one, step two, and step three, and we need to take a decision on the nature of this particular arrangement, JV or a JO. So let me create some permutation combinations out here, and let's have a look at whether it turns out to be a JV or whether it turns out to be a JO. So let's consider this to be step number one. Let's take this as step number two. First is the legal form, then the terms of the arrangement, then the other facts and circumstances, and we need to decide the type of joint arrangement in this particular case. Let's first make a run through in terms of the different combinations which could occur in these steps so that you understand when which step is applied and what kind of conclusions will come based on the permutations and combination. Let's say I looked at the legal form. Let me just put it out here. I looked at the legal form. Then I looked at the terms of the arrangement. And then I looked at the other facts and circumstances. So let's consider the combination one. I looked at the legal form and I said it is a JO. It's a firm. I said it is a firm, and therefore I said it's a JO. I went to the step number two and I said in this particular case that they are getting a share in the assets, liability, income, and expense. Third step, not required. So on this basis, I decide it is undoubtedly a JO. You created a firm, so let's put it like this. Let's, I think, put it like this for a clarity. So let's say we created a firm. So it became a JO. So my step number one tells me it's a JO. My step number two tells me JO. Third step not required. The conclusion is it's a JO. Let's look at the combination two. Let's say we decided it is supposed to be a JO firm, same. Now they are getting a share in the net assets and they're getting a share in the net profit. That means it is a JV. I'm creating permutation combinations based on this. Step one is saying JO. Step two is saying JV. Third step not required. Step number two overrides step number one. I hope you can see this clearly. Step number two overrides step one. There is no contradiction, JO. Step number two overrides step number one. There is a contradiction, so JV. Step number one, practically the relevance is gone. Let's look at another combination, 2A. Let's say you created a company, or let's say you created an LLP. So we said it is a JV. And in this case, we said they're going to get net assets and net profits. So we said it is again a JV. See the combination carefully. A company or LLP indicates a JV. A net assets and a net profit indicates JV. We're not applying step number three. Step number two overrides step number one, JV. You can guess the next combination coming in. So let's say this is same JV, company, LLP, but they're getting a share in the assets, liability, income, and expense, JO. Third step not required, but it's going to be a JO. So one thing which is very apparent, but I think I would still like to pinpoint it very clearly to you, leaving no, any confusions at this stage. You can see step number two is the overriding clause, JO, JV. You can see the step number two is the overriding clause, and the step number two is the overriding clause, JV and JO. And I know, again, the question coming to mind would be, what is a good need in terms of step one? We're still forgetting the larger picture. Step one plays a role when step two and three are silent. Otherwise, step number one doesn't have a role to play. Let's see some more combinations coming in this time. Now let's consider number 3. It can be either case, you decide a JO or you decide a JV. You decide a JO or a JV. And in terms of step number 2, it is silent. So now if you decide it is a JV, then it is JV. If you decide JO, then it is JO. You decide anything in step number 1 and the step 2 is silent. So what you decide in step 3 is the deciding factor. So you can see step 2 overrides 1, step 3 overrides 1. Now let's look at the last permutation combination on this. You decided a JO or a JV. The step number 2 is silent. The other facts and circumstances silent. This is the only case where you can say the step number 1 is the decision maker. Because if step 2 input is given, 2 decides. If step 2 is silent, 3 gives you the information, 3 decides. 2 and 3 silent, then step number 1 is the deciding factor. Now I would say, based on the step number 1 itself, whatever you decided in step 1, that becomes the answer. I hope, friends, I am pretty much clear on the permutation combinations in terms of deciding a JV and a JO. No separate vehicle, JO. Separate vehicle, 3-step model, which decides the fate. Step 2 overrides 1, step 3 overrides 1, and if 2 and 3 silent, step 1 is the decision maker. Let's come back on the agenda. We started a journey in terms of 3 issues related to the concept of a joint arrangement. I've covered 2 issues with you. I've covered the concept how to identify a JA. What is the type of a JA? Now comes the aspect of accounting. I want to make a very interesting combination chart at this particular stage, giving you almost all the permutation combinations in terms of that what is the accounting in a separate and a consolidated financial statements in various permutation combinations. Watch this chart. You're going to love this chart or you're going to hate this chart. Either you're going to love it because it contains all the combinations, or you're going to hate it because it contains all the combinations. Because when you see that, you're looking at that particular chart with all the pluses and minuses, looks dangerous. But I think I'm very keenly interested in making a chart. But before I make this particular chart, there is one particular clarification which is coming to my mind, and I think we need to keep that in mind. Remember that example of ABC, where I said A is got a 50 and B is got a 30 and C is got a 20. Let me just remind you that example before we make the chart. So before I go to the issue number 3, I think I just want to, quickly take you on that particular issue. So before we go to the issue number 3, let me just remind that combination ABC. So let's say A has got a 50% stake, B has got a 30% stake, and C has got a 20% stake, and we need 75% to take decisions. So let's consider we need a 75% to take decisions, and this is the percentage. Now, we already made an assessment earlier that can A block decisions? Yes. Can B block decisions? Yes. But C cannot block decision. Because if A and B join together, they can take decision, they can achieve a 80% combination. So we decided in this particular case that C has no joint control, but you need to make an assessment whether he's got a significant influence or not. Is he a party to the arrangement? Yes. Is he got a joint control? No. Look at the combinations questions very carefully. The question number 1 is, I'm putting across the question number 1, is C a party to joint arrangement? Is he a party to the joint arrangement? I would say yes. He's certainly a party to the joint arrangement, but I put across another question, has C joint control? And the answer is no. This is with reference to C, but look at the situations in terms of A and B. If you look at in terms of A and B, I can say the question number one is A and B have joint control? Or rather, first, let's put it that are they party to the joint arrangement? Let's put the same questions. Is A and B, are they party to joint arrangement? And I would say yes, they're a party to the joint arrangement. And then I would put across another question to myself that does A and B have joint control? I would say yes. I would say yes, they've got a joint control as well. Now, the interesting part which needs to be understood is A and B are party and have a JC. C is a party but does not have a JC. So do you think the kind of accounting applicable to AB and the kind of accounting applicable to C is going to be same or different? Should be different, no? As A and B are parties to the arrangement with joint control, and C is a party to the arrangement without a joint control, and Ind AS 111 makes a distinction in terms of the fact that if you're a party to a JA and you've got JC, your accounting is going to be different as compared to that you're a party to the JA, but you don't have a joint control. So in those particular cases, we are going to get a different treatment in the books of accounts. So my mind is working on now some very crucial permutations and combination. Trust me, I am going to give you the comprehensive permutation combinations of all the accounting treatments in this particular chart. As I said, you're going to love it or you're going to hate it. I don't know. You should love it actually. Let's have a look. So I'm going to make some permutation combinations out here. And I'm looking at the fact, number one, I'm looking at the fact that we're looking at separate and consolidated financial statements. So I am going to look at something like this. And I'm going to divide this further out here. And I'm going to divide this further out here. And I'm going to divide this further out here. Wow, looks interesting indeed. Let's tell you what is going in the back of my mind. So I am looking at the kind of financial statements, separate, consolidated financials. I'm looking at a JO. I'm looking at a JV. And I'm looking at parties with a JC, joint control, and parties with no JC. So this is more or less, you can say, the case of A and B, and this is more or less a case of C. So we're looking at parties with a joint control, and we're looking at parties with no joint control. I think that gives me a total of 8 permutations, combinations in this particular case, which will give me a complete clarity in terms of thoughts. So I guess let's again have a look at this thought process which I gave you. So my mind is working on the fact that when looking at parties with a joint control, we're looking at the parties A and B. When we're looking at the parties with no joint control, we're looking at C. So when you're looking at the parties with a joint control, we're looking at A and B, and parties without a joint control, we're looking at C. So there is going to be a different treatment for A and B and C in case of JO and JV, in case of separate and a consolidated financial statements. Now, what's this carefully? As I've already said, that in terms of a joint operation, Ind AS 111 accounting would trigger. But in case of a joint venture, we're going to shift and go to Ind AS 28. So the moment you say that it is a JO, you are within 111. And the moment you say it is JV, you are out of 111 and you are under 28. So one thing very clear. So when you're looking at this particular combination, any of these, You're looking at any of these four combinations, it is a same accounting. Any of these, we are looking at a same accounting in this case. Because we're looking at the application in terms of Ind AS 111. Same accounting is prescribed. What are you going to do? To the assets, add the share in the assets. To the liabilities, add the share in the liability. To the incomes, add the share in the incomes. And to the expenses, add the share in the expenses. So we are basically going to do one thing. When I make my financials separate, consolidation, irrespective, I will take my asset and the share in the assets of the JO. I will take my liabilities and the share in the JO, revenues and expenses, my share in those. So what we'll do, we will consider the own assets, liability, income and expenses, and we will add the share in joint operation, asset, liability, income and expense. As simple as that. Whether it is separate, whether it is consolidation, whether it is a case with a joint control or without a joint control, JO Ind AS 111 does not make a distinction between any permutation combination. So whether you tell me the accounting in the books of AB or you tell me the accounting in the books of C, whether you tell me it is in separate, whether you tell me it's in consolidation, I will say it is the same accounting. You take your own asset, liability, income, expense and add the share in the asset, liability, income and expense. Simple and straight. Now let's come to the case of JV, and let me remind you, we are out of Ind AS 111. So we are basically looking at the inputs in terms of 28. Now watch this carefully. If you're a party with a joint control, then in this particular case, in the separate financial statements, you will apply Ind AS 27. You will consider the investment at a cost or a fair value. That's your accounting policy choice. Ind AS 27 is applicable. Mind you, Ind AS 27 is applicable for investment in a subsidiary, investment in a, you can say, joint venture or investment in an associate, not a JO, not a JO. And that's the reason you can see that Ind AS 27 is not applicable out here. We need to be very clear that as far as Ind AS 27 is concerned, it is applicable only to three. If it is a subsidiary, if it is a joint venture, or if it is an associate, not JO. So separate financial statements, you apply Ind AS 27, where you can take the investment at cost or it can be taken at a fair value. When you say fair value, if you choose that fair value, you're back to Ind AS 109. So Ind AS 109 per se is not applicable to related party, but Ind AS 27 gives you a choice of accounting policy. You can take the investment at a cost model or you can take a fair value. If you choose a fair value, you're back to Ind AS 109. FPTOCINR or FPTPL, whatever. Though practically, one would always choose a cost model as well. Next. If you're looking at a consolidated financial statements, we are under Ind AS 28 for A and B. Mind it, separate is 27 and consolidation is 28. And in terms of consolidation 28, what we're going to just see after the standard, we are basically going to carry this investment using what we call an equity method of accounting. Ind AS 28 gives me the concept of what we call an equity method of accounting in this particular case. So you will carry the investment in the consolidated financial statements based on equity method of accounting. Simple. Now comes the crucial aspect in terms of this permutation combination. Now, in terms of this permutation combination, the focus is on C, who is, in this particular case, we are saying, is got no joint control in this particular case. So what we're going to do, he will also apply, rather, let me put it like this, he will first assess. He will first make an assessment. He will assess There is no joint control, but we'll say, is there a significant influence? We will make an assessment that not a joint control, but do you got a significant influence in that case? So the answer could be a yes, or the answer could be a no. So when you're looking at the fact that there is no joint control, you'll say, okay, let me assess that is there a significant influence or not. If you say yes, there is a significant influence, I would apply Ind AS 27. So you're back to the same accounting. You're back to the same accounting. I would apply Ind AS 27 because Ind AS 27 applies to JV and associate both, and of course subsidiary. But if you say no, there is no significant influence, then in this particular case, you would apply Ind AS 109. Here you're getting a choice. Here you're getting a choice. And in this particular case, if there is no significant influence, you are definitely under Ind AS 109, in which case you would apply the concept of fair value, which is either considering investments at FPTPL or FPTOCI as the case may be. So this is a situation when the party has got no joint control. You'll say, okay, let me assess, is there a significant influence? If yes, 27. If no, passive investor 109. Let's now look at the consolidated financials as well. Here again, the same thing is to be done. You need to make an assessment and see, is there a significant influence? Here again, you will see that is there a significant influence in this particular case? Interesting. If you say that there is a significant influence, the answer is a yes or the answer is a no. Now, if you say yes, there is a significant influence, I would again apply Ind AS 28. So you're back to the same accounting treatment in this case. Because if you've got a significant influence, you're required to do the consolidation as per Ind AS 28 equity method. Now, if you say there is no significant influence, you become a passive investor, then in that particular case, consolidated financials not required. The consolidated financials not required because now you become a passive investor. Wow, interesting. Let's quickly consolidate the picture. So as far as a joint operation is concerned, you remain under Ind AS 111. So Ind AS 111 makes the life very simple. You say that I'm making separate financials. Okay. You're making a consolidation. Okay. You got a joint control. Okay. You got no joint control. Okay. I don't care. Don't give me permutation combinations in this case. Simple accounting in all permutations combination. You take your asset, liability, income, expense, and just add the share. There has been 1 or 2 questions in the study material, which is giving you the accounting under 111. Though there is one very interesting question, which I remember came in the revisionary test papers, which is on, one of the oil companies, which is given, where there is a beautiful application of Ind AS 103 along with the concept of Ind AS 111. But I think I'm not getting into that question at this stage. But do make a reference to that particular question because that is, not incorporated in this chart. So you must have a look at that particular question where there is an oil company. It's an RTP question. I think it's in the study material as well now, where you're given that, in this particular case, if it becomes a business, the accounting prescribed under 103, acquisition accounting gets triggered in that particular case. Anyway, so this is 111. When you're a joint operation. Now comes the crucial part. When you're saying that it is a JV, you need to be careful. Are you talking of separate? I'm concerned. Are you talking of consolidation? I'm concerned. Are you talking that the parties have got joint control? I'm concerned. Are you talking of parties without a joint control? I'm concerned. A different answer in all the combination. Remember, in a separate, when you've got a joint control, 27, in a consolidation, 28. 27 gives you a choice between cost and a fair value. Fair value means 109. Consolidation means 28. And when you say they're not a party to the joint arrangement, if you've got a significant influence, same accounting treatment follows. But if there is no significant influence, then in this case, it is 109 fair value and no consolidation in this case. Simple and straight. I guess now I would like to come back on the inputs with which I started off. I think I've answered all the three issues at this particular stage. Now you can see that I've given you the joint arrangement identification three-step model, the type of joint arrangement, a three-step model, and the accounting in terms of the financial statements. I've given you a comprehensive chart. I think now you've got the entire essence of Ind AS 111 at this particular stage. Let's now go to the next standard. Let's trigger off a bit of our discussions. So, and then we'll give you a break after some time. So, but let's first trigger off our discussions on 28. So 111 is done. Then let's go to Ind AS 28 now at this stage. So now we are looking in terms of Ind AS 28, which is investment in. It is dealing with accounting for investment in associates and joint ventures. And of course, it does not apply to a joint operation. I've already made a mention that it does not apply to the concept of a joint operation. At this stage, I think I'll now like to give you some clarity points at this particular stage because I think that is necessary. So if you ask me in terms of Ind AS 28, I would again say that there are three areas of major discussions which are done in this particular standard. So I would make a list of three issues again. So every time you got three issues in hand, well, it's a chance. The standard is addressing three issues. So we are also addressing three issues only. Well, I think the first is the assessment of significant influence. First is the assessment of a significant influence, which generally we know that it is not a rule-based assessment. We have said earlier as well, and it is a principle-based assessment. But in this particular case, generally, the standard says if you've got 20 or more than 20% voting power, you do get a significant influence, but it is a matter of assessment. So we'll see how does the assessment of a significant influence happens? And along with this, there are also cases when Ind AS 28 accounting is not applicable. So you need to be also careful on this particular area that you identify a significant influence, but still Ind AS 28 does not trigger. The case of that venture capital, the case of that unit trust and all those cases where we say that, you get certain choices. You get certain choices, and I'm looking in terms of typically para 18, 19. If you look at the detailed lectures, what we covered in the previous batch, you will see that I've covered a detailed inputs on the application of para 18, 19. So we'll take a quick review today, of course, but if you look at the insights, para number 18 and 19, this deals with the entire application. When Ind AS, I would not say is not applicable. That would be wrong to say. I would say Ind AS accounting, you get a choice. You got a choice in terms of Ind AS 28, in terms of para 18, 19. And there has been some very interesting questions which are there in the I think came in the RTP as well. One very interesting question came in the RTP, which I will, I think, quickly run through with you. So these are the two things as far as issue number one is concerned. Then there is a second issue. And the second issue is with regard to accounting. Once you've identified that, this is like, I would say this is like discussing the scope of the standard. One interesting thing which comes to my mind, as you study these standards, keep one very interesting point also in mind. And that is, when you are deciding that I am in a certain standard or not, you first of all look at the definitions, recognition parameters, and you say, yes, I am within the standard. You make an assessment and you say, yes, there is a significant influence. But immediately you need to decide the scope of the standard, whether you're scoped in or scoped out. Because many times you will be able to meet the definitions criteria or the recognition criteria given in the standard, but in spite the definition recognition parameters are met, when you look at the scope of the standard scopes you out. And even though you met the triggering conditions of definition recognition, but you're scoped out of the standard. So this is what you should keep in mind, that you are saying there is a significant influence, but you're not within the scope of this particular standard. The second is the accounting, and we just made a mention the accounting is based on what we call the equity method of accounting. So we'll have a look at what is this equity method of accounting. Just I gave you a crux in terms of 110. The 7 steps which you need to apply in terms of consolidated balance sheet and the considerations in income statement. We'll have a look at the application of equity method, where I'm going to give you a simple 2-step model. So we're going to see how the equity method applies in a 2-step model. And then finally, there is something which is given in the appendix to the standard. And this is something, very interesting indeed, what is given in the appendix of the standard. Other long-term interest in the associate. As an investor, apart from the ordinary shares in the investee, we may have other long-term interest, and these are interest which is supposed to be, you can say, in the kind of instruments which are as good as equity. Something, what you do in Ind AS 21, what do you call it, as a net investment in a foreign operation. So you pumped in money in certain long-term loans, etc., where there is neither any pre-decided date of repayments, nor there is any intention to make repayments. So it talks about the accounting if there is other long-term interest. There is other long-term interest in terms of the associate, which could be in terms of holding preference shares, certain category of preference shares and debentures. So this is looking at holding of the preference shares and holding of the debentures which are there. So I spent a good time in terms of giving you an insight of this Appendix B in terms of Ind AS 28, which gives you a lot of insight in terms of how the accounting is done. So I would say the 3 broader issues which are addressed in terms of Ind AS 28, you need to understand how do you assess a significant influence, and what are the cases when you are still scoped out of the standard, or you get a choice of not applying the equity method of accounting. Once you establish that you are under the scope of the standard, you look at how does equity method apply. And then there is the concept of other long-term interest in terms of preferences and debentures in the company. So far, so good. I guess we got the basic connect in terms of things. I think with this particular background, before we start with these 3 critical issues, I think it's time to give you some break, first of all. So your mind gets relaxed. We're out of Ind AS 111 and we enter into Ind AS 28. The grounding work is done. I will start discussing these issues on one-by-one basis after the break. So let's, I think, give you a quick 10-12 minutes break at this stage, and then we commence back on a journey on Ind AS 28. So let's take a break. Enjoy your break. Okay. I hope you have got a relaxed mind. So I think we were discussing the issues as far as Ind AS 28 is concerned, and I give you a list of three issues again. So let's start with a discussion on the first issue. That is, how do you assess a significant influence under Ind AS 28? So let's begin the journey and let's have insight on the issue number one. Now, in the first issue, we are looking at the assessment of significant influence. When do we say significant influence is present, and when do we say no, it is not present? Well, I think the general thumb rule which is given in the standard is that as an investor, if you've got directly, indirectly, now that's one point which I want to elaborate at this stage. The standard says that if you've got directly, indirectly 20% or more than 20% voting power in an investee company, you get a significant influence. Now, watch this. So there is a general thumb rule. And the general thumb rule is that if you're looking at a significant influence, if you've got 20% or more voting power, I'm putting it as VP. So if you've got 20% or more voting power, the thumb rule is you've got a significant influence, but then there are certain exceptions. And the standard brings into light what are the exceptions, where even if you've got 20% or more voting power, there may be no significant influence. But let's say you've got less than 20% voting power, but still you've got a significant influence. And this assessment requires certain evaluations of parameters, which I'll come to very shortly, that what are the parameters with the help of which we will take a call, whether in this particular case, the significant influence is there or not. But let's first make it very clear that when the standard says 20% or more voting power, it says directly, or indirectly. And when it says indirectly, the important input is indirectly through subsidiary. It is indirectly through a subsidiary. That's the most crucial point. That when you say you've got 20% or more than 20% voting power, indirectly, it has to be through a subsidiary. If you've got indirectly through a associate itself or through a JV, you're not going to consider that for the application of Ind AS 28. So let's have a look. So for example, let's say we've got A and let's say we've got B, and let's say there is a C as well. Now A is got, let's say, a 60% in C. And A is got, let's say, a 20% in B. And even C is got, let's say, another 20% in B. So in this particular case, we can say that A is got directly in B and E is got indirectly through a subsidy. So this is the focus which I want to pass through. It is indirectly through a subsidiary company. It is indirectly through a subsidiary company. Let's say if this relationship of A and C is not a case of subsidy, but let's say it is a case of, let's say, a significant influence or a joint control, then I would not consider this. And another important inputs to be given at this particular stage is, if you tell me that A is got a significant influence over B, I would say yes, he's got 20% direct and he's got 20% indirect. He's got a 40% stake. Why I'm pinpointing this particular part is, let's say if this was 12 and let's say this is 8, B is still an associate. 12 plus 8 makes it 20. I will not consider 60% of 8. So when you're looking at the establishment of the relationship, I will not say it is 60% of 8% in that case. I would say 12 plus 8, it makes it 20. So B becomes an associate of A. But this is one thing. Establishing a relationship means counting the percentage directly. So we would take, in this case, 20 plus 20. This is for the purpose of establishing the relationship. This is to establish the relationship. So when you're establishing the relationship in this particular case, we will undoubtedly look at 20 plus 20. But the other part is that when you're going to do the accounting, When you're going to do the accounting under equity method, I will not say it is 20 plus 20. I will say 20 plus 60% of 20. And I would say that A is got a 32% stake in the net assets of B. So there are two important crucial points which I've given you as far as the assessment of significant influence is concerned. When you look at the presence of a significant influence, you need to consider direct and you need to consider indirect as well. But indirect is to be through a subsidiary, not anything other than a subsidiary. So as an investor, if I've got an indirect holding through a joint venture or through a significant influence, it would not qualify for the purposes of establishing the relationship under this standard. There is one focus point which you need to keep in mind, that establishing a relationship, you'll add direct and indirect without taking 60% of 20, but it has to be through a subsidiary. That's one. And second is that even though you add a percentage for establishing a relationship, but when it comes to accounting, when you need to establish that A has got a share in the net assets of B, we're going to consider it to be 20 and 60% of 20, that is 12. I hope the first agenda is very clear. Establishing the relationship on what parameters? Add direct, indirect. But when you add the indirect, take only the subsidiary into account. Number two, when you're considering the accounting in terms of calculating the share in the net assets, then you need to consider direct and don't add the indirect as it is. You need to take 60% of 20, that is 12. Now, coming back to the agenda, the general principle is there. Now we need to see the exceptions. So let's see what are the additional parameters. What are the additional parameters which the standard has given us in terms of deciding and evaluating whether a significant influence is present or it is not present. So the standard has given us a list of 5 additional parameters. The standard has given us a total of 5 additional parameters on the basis of which we will decide, whether the significant influence is present or not, in spite of the fact that there could be, more than a 20% stake in the company. Still, we might say that there is no significant influence in that particular case. So what are those parameters? Number one, the standard says representation. The standard says representation on board of directors. As an investor, you've got a representation on the board of directors of the investee. Now, it is not important in terms of how many directors are represented on the board, but what is important is that you may have less than 20% stake in the company, but along with a less than 20% stake, you've got, let's say, a representation on the board of directors as well. So this is, you can say that you've got less than or more than 20%, but let's consider you've got less than 20% voting power. And along with this, you've got certain parameters like representation on the board of directors. You've got a participation. You've got a participation in policy making process. It's not that you can take decisions. You are in a position to participate. So participate in the policy making decisions. So as an investor, if I've got the right to invest, right to take, participate in the decision-making policies of the company, I would say, yes, could be a significant influence. The next is, we can say that there is interchange of managerial personnel. There is interchange of managerial personnel. So let's say you've got common directors. So you've got common directors with each other. So you can say director of the investor and the director of the investee, they're common. You've got interchange of managerial personnel. That is one. Then you can say providing essential information. So you can say providing essential information, or I would rather say providing, you can say essential technical information. So when you're providing essential technical information, then we can say it could be indicative of a significant influence being present. Or it could be a situation where we can say that there are material transactions between the investor and investee. So there are, let's say, material transactions which are there between the investor and the investee. So if there are any kind of material transactions between investor and investee, we can say it could trigger the concept of a significant influence. So the standard has made one thing very clear, and that is when you are looking at the presence of a significant influence, in terms of the presence of significant influence, you need to go with the thumb rule 20 or more than 20 directly, indirectly through subsidiary. You could qualify for being an investor which has got a significant influence over investee. But in spite of the fact that you've got more than 20 or less than 20, significant influence still could be based on these 5 parameters: representation on the board of directors, participation in the policy making process, providing essential technical information, interchange of managerial personnel, and any kind of material transactions between the investor and the investee that could be indicative of the inputs. Now, I think let's go to the next part. So this is one part of the issue number one. How do you assess a significant influence? Now comes the second agenda, and that is the para number 18 and the para number 19, where I think I would like to take that question which came in the RTP for a quick remembrance of the concept. I'll explain that larger concept also along with that question. I'll just quickly give you the inputs which were there in that particular question, which is there in the RTP as well. So this came in RTP in May 2020. So let's give you some insights on that. So let's have a look at the question which came in the RTP in May 2020. So I'm looking at the RTP of May 20. I'll just give you quick facts and we'll take a call in terms of how does para number 18 and the para number 19 gets triggered. Now, in this particular case, we were given that entity P has got two wholly owned subsidiaries. So let's say there is a company P Limited, and this company P Limited has got, let's say, two wholly owned subsidiaries. So we given the two subsidiaries X and Y, and these are wholly owned subsidiaries. So X Limited, you've got 100% stake, and Y Limited also you've got 100% stake. So it has got a two wholly owned subsidiaries, and it says each of which has got an ownership interest in an associate entity Z. So each of them has got a stake in Z. So he's also got a stake in Z, and he's also got a stake in terms of Z. So that was the permutation combination. So it says each of which has got an ownership interest in Z. Subsidiary X is a venture capital organization. So this is supposed to be a venture capital organization, putting it as VCO. And then it says neither of the investments held in Z by subsidiary X and Y is held for trading. So these investments are not held for trading. So no FPTPL. Subsidiary X and Y account for the investment in associate at FPTPL in accordance with 109 and using equity method in accordance with Ind AS 28. Now what it mentions is subsidiary X and Y are accounting for investment in associate at fair value in accordance with the separate financials, and it says using equity method as per Ind AS 28. So what X and Y are doing, it says X Limited as well as Y Limited, they are considering the application of Ind AS 109. They are considering the application of Ind AS 109 in terms of separate financials, and they are applying Ind AS 28 in terms of consolidated financials. So both these subsidiaries are accounting for separate financial statements. They are following FPTPL. That's what is mentioned. And they're using equity method in accordance with Ind AS 28. Okay. Sorry, my mention. Subsidiary X and Y account for investments at FPTPL. Sorry, it is respectively. It is respectively. My mistake. So let me just rectify this. It makes a mention that subsidiary X and Y, they are applying. So he is taking FPTPL in accordance with Ind AS 109 out here, and he's accounting for Ind AS 28, that is applying an equity method of accounting respectively. Now, how should P account for the investment in Z in the following scenario? So we are looking at the accounting in the books of P in three different scenarios. So I'll just quickly make a run through of these three scenarios. But before that, let's have a look at what does the para number 18 and the para number 19 tells us. Now, if you look at para number 18, the para number 18 focuses that if you're having a significant influence through a subsidiary, which is supposed to be a venture capital organization, a unit trust, or a mutual fund. Mind it, para number 18 says that if you've got an investment in an associate through a subsidiary, which is a venture capital organization, mutual fund, or unit trust, in those particular cases, you get a choice. In those particular cases, you've got a choice. Either you account at FPTPL or you account under Ind AS 28 equity method. You've got a complete choice altogether. Para number 19 is telling you that if as an investor, you have got something which is, one portion which is directly held in an associate and another portion which is indirectly held through a subsidiary, and that subsidiary is a VCO, you get the choice of accounting policy even in terms of that portion. I think let me just put that once again. There is interesting inputs in terms of para 18-19. For detailed inputs in terms of para number 18 and 19, my advice is please have a look at the detailed lectures, what we have covered in terms of 28. So in this particular case, I am looking at the inputs in para number 18, and I'm looking at the inputs in terms of para number 19. Now, what does the standard give me an input in terms of para number 18 and in terms of para 19? Para number 18 is on the point. Let's say you are investor A, and let's say there is a company B, and let's say there is a company C. It's more like a chain. So A has got stake in B, B has got a stake in C. So let's say, for example, that A has got, let's say, a 60% stake in B, and B has got in C, let's say, a 20% stake. And B is supposed to be either a mutual fund or a venture capital organization, or let's say a unit trust. So A has got, let's say, a stake in B, a subsidiary, and B has got a stake in C that becomes an associate. So para number 18 very clearly tells us that in this particular case, since you've got an investment through a subsidiary, which is a mutual fund, venture capital, or unit trust, A gets a choice in this particular case. A gets a choice in this particular case. He can either account for the investment in A and C, either using a fair value through profit and loss account, or he can apply the equity method as per Ind AS 28. So the standard gives a complete choice in terms of A, that if your investment is held through a subsidiary and that subsidiary is either a venture capital organization or a mutual fund or a unit trust or similar kind of entity, then he gets a choice that if he wants to account for the investment A in C, either he applies FPTPL or he uses an equity method under Ind AS 28. Similarly, if you look in terms of para number 19, para number 19 says, let's say the same example, A, and let's say B, and let's say in terms of C. So let's say A has got a stake in B, and B's got a stake in C, and let's say A also has a stake in terms of C. So para number 19 would trigger when you've got direct and indirect stake. So you got a direct indirect stake. So you got two portions of the investment. One is a directly held portion and one is an indirectly held portion. So let's say he's got a 60% stake and he's got a 20% stake. And let's say this is also a 20% stake. Intentionally, I am considering a 20% stake in both the cases so that, at individual levels also, they remain associate. A in C directly is associate. A through B in C is also associate, intentionally taken the 20% stake. Now, we can say in this particular case, if you look at the parameters in terms of 19, we can say there is direct and we can say there is indirect, and let's say this is a venture capital organization or a mutual fund or a unit trust. So I would say this is indirectly held. Now, in this particular case, we can say that there are two portions of the investment. One is a direct and one is an indirect portion. So remember, para number 18 triggers when you've got only one indirect investment. And para number 19 triggers when there is a combination of direct and indirect. So there is one portion and there is another portion. Now, what does the standard tells me in this case? As far as the direct portion is concerned, you would 100% apply Ind AS 28, that is equity method. And in terms of this indirect percentage, you got a choice. You got a choice, either we apply the equity method or you apply the FPTPL in this particular case. And the standard also made a wonderful clarification that this is going to be irrespective whether you say that this individually becomes an associate or not, this individually becomes an associate or not. So whether this is on a standalone basis associate, this is an associate, or collectively an associate, that doesn't make a difference. Till the point of time you can say that A directly in C or A indirectly in C collectively makes it an associate, whether these percentages are associates individually, one is an associate, other is not, both are not associate, but collectively they are, it doesn't make a difference. We will still reach the same conclusion. So let's come back on the RTP question, which was May 20. So let's, I think, look at the facts of the case. We can see that B is got indirect investment in Z. P is also got indirect investment in Z through subsidiaries. But let me also tell you that para number 19 is not necessary that it is always direct indirect. Para number 19 could also be indirect as well. One of the indirect portion is without any, you can say, subsidy, being venture capital, mutual fund, etc. And one is an indirect, which is through. So in this case, we can say this is indirectly through VC. And this is indirectly, but not a VC. So there are two portions. So what is more important in terms of para 19 is two portions. The moment it is one portion, a single investment, indirect, it is 18. The moment it is, two portions, direct plus indirect, or we can say indirect plus indirect, in those particular cases, para 19 would trigger. So let me, I think, put this once again very, very clear. So I would say the triggering point in terms of para 18 is when it is indirect only. When it is indirect only. That's the crucial point. So when you see that it is indirect only through a VC, through a mutual fund or unit trust, it is para 18. And when would para number 19 trigger in this particular case? When we can say it is direct plus indirect, one combination. And that indirect is through a VC. Or it could be another combination that is indirect plus indirect. It is indirect plus indirect in this particular case, in which case, again, one of them could be, through VC, another one could be without a VC. But what is important is that it is two portions. So what is important is it can be direct, indirect, it can be indirect, indirect. But what is important is that there are two portions of the investment. So when it is one particular investment, indirect, para 18. When it is supposed to be two portions of the investment, it could be direct, indirect, it could be indirect, indirect, but of course not direct, direct. Because para number 19 would trigger only if out of the two portions, at least one is indirect, or maybe both are indirect in nature. And para number 18 would mean that one investment itself, one portion itself is indirect in nature. I think with that essence, let's come back to this example. So we can say in this particular case, what they've given you is indirect, indirect. So we can see that it is indirect and it is indirect. And in this case, since it is indirect plus indirect, we very clearly know that para number 19 is going to trigger in this case. Because many times, students tend to get confused and identify, is this a case of para 18 or is this the case of para 19? So I am just putting that once again for convenience. Your para number 18 would trigger when it is a case of an indirect percentage only, one investment indirect. The para number 19 will trigger when there are two investments. One could be direct, one is indirect for sure. And both can be indirect. And one of the indirect portions is supposed to be through a venture capital. So the standard says you get a choice in terms of accounting FPTPL or equity method for one of those indirect portions held through a VC. Now, in this case, what we were given in the question were three permutations and combination. It said in scenario number one, both investments in the associate result in a significant influence. So we're taking combination number one. We're looking at X in Z and we're looking at Y in Z. So we're looking at the percentages X in Z and we're looking at the percentages Y in Z. It says X in Z is 25% and Y in Z is 20%. So we can see this is a case of an associate independently. This is also a case of associate independently. So would para number 19 trigger in this case? Yes. So I would say the first thing is, would para number 19 trigger in this particular case? Yes, it will trigger. And do I get a choice in terms of accounting? That means in terms of X and Z, will I be able to use the choice of FPTPL and equity method? Yes. And in terms of Y and Z, I would do the accounting based on FPTPL. So two portions of the investment, the portion which is held indirectly through a subsidiary being a venture capital organization, you get a choice 109 FPTPL or equity method 28. And for the other one, FPTPL. Then he gives you a second permutation combination. Second one, it says where neither of the investments in the associate results in a significant influence, but they do provide the parent with a significant influence on a combined basis. So he gives you that X in Y and Y in Z, they're both 10% each. Significant influence is definitely getting established between P and Z. Because P through X and P through Y has got a 10% stake each. So Z definitely becomes an associate in terms of P. Would the answer still remain the same what we did in case number one? Yes. The clarification which is given in the standard is based on the input that the moment Z is an associate, it doesn't make a difference that this is a lone significant influence, good. This is not a significant influence, but this is a significant influence, good. This is not a significant influence, this is not a significant influence alone, but collectively, yes, the answer remains the same. So they gave a third scenario as well, X in Y as well as Y in Z. And in this case, it says that one of the investments result in a significant influence and the other one does not result in a significant influence. So there is a 30% in X and Z. Sorry, not X and Y. This is, I'm afraid, X and Z. So this is X and Z 30% and this is 10%. Would the answer still remain the same? The answer is yes. So irrespective in these particular cases, the answer is going to be a yes. The moral of the story based on this particular question was very simple. Para number 19 is going to trigger in a situation where you've got one portion of the investment direct, indirect, and you've got another portion which is indirect. So it can be direct, indirect, it can be indirect, indirect. One of the portions which is indirect is through a venture capital, unit trust or a mutual fund. So you need to consider the accounting for the two investments separately. What is direct or what is indirect without VC? Ind AS 28. And what is indirect through VC? Then you get a choice, Ind AS 28 or FPTPL. And secondly, this particular choice gets available irrespective whether they are on a standalone significant influence, they are standalone no significant influence, but collectively yes, and one is significant, another one is not. I think it's a beautiful illustration which is there in the RTP. This question was also there in the education material in Ind AS 28. Okay, so I think coming back to the agenda, I started my inputs with you in terms of three agendas with you. So I think we've covered the very first agenda with you. So we've covered the aspect of assessment of a significant influence and also the scope when para number 18 and 19 would trigger and you get choices in terms of accounting. Now let's come to the concept of the equity method of accounting. So when you say that yes, you are under the purview of Ind AS 28, how does an equity method apply? So let's make your life simple on that. So I guess let's go on further and let's now consider the concept of issue number 2. So we'll come to the concept of issue number 2 where we're looking at the equity method of accounting. So we're looking at the equity method of accounting, which is applicable to a joint venture as well as the concept of you can say associate as well. Now, let's keep one focus very clear. When you're looking in terms of equity method of consolidation, I would say there are two stages in terms of things. We'll just first run the concept through, then we can take a small little example also. So first, let's have a look at a concept in terms of application of the equity method. When I look at the concept of an equity method, I always say that there are two stages in which accounting is done. The stage number 1 is, you can say, on the date of acquisition. And the stage number 2 is that you're looking at the post-acquisition accounting. So we divide our accounting in stage 1, which is acquisition date, and the stage number 2, when you're looking at a post-acquisition accounting. So let's have a look. So when we're looking in terms of equity method of accounting, we can say there are two stages. The stage number 1 of accounting is in terms of, you can say, DOA, that is on the date of acquisition. And trust me, what you do on the date of acquisition is simply a same exercise what you do in terms of calculating goodwill under 103. You need to compare the cost of the investment and you need to compare the share in the net assets at the fair value on the date of acquisition. So let's consider in this case, what you need to do, you need to compare, you can say the cost of the investment, and this is to be compared with the share in net assets at fair value on the date of acquisition. So look at the focus very carefully. We are looking at two focus points in terms of things. We're looking at the share in the net assets at a fair value, and that is on the date of acquisition. So what I paid as an investor, that becomes a purchase consideration investment, and what I get a share in the net assets at a fair value. You compare the two, and this comparison is going to give us a goodwill or a capital reserve. So you're going to get a goodwill or a capital reserve by comparing this. And this stage 1 is called the initial recognition. The stage 1 is called the initial recognition, where you compare the cost of the investment versus the share in the net assets at a fair value on the date of acquisition. And in this case, remember, this goodwill or capital reserve which is identified does not appear separately. It does not appear as a separate line item. So this does not appear as a separate line item in the balance sheet. So it does not appear as a separate line item in the consolidated balance sheet of the company. This is reflected as a part of the carrying value of the investment itself. So when you reflect the investment in the consolidated balance sheet, you reflect the investment, and in the inner column, you just give a disclosure regarding the goodwill which is identified on initial recognition. So it does not appear as a separate line item in the consolidated balance sheet of the company. So initial accounting is pretty simple. Just identify the goodwill or the capital reserve and present it as a part of the carrying value of the investment without reflecting goodwill as a separate line item in the balance sheet. Next. Then comes the stage number 2. Which we can call it as a post-acquisition accounting. The stage number two is what we call the post-acquisition accounting. Now, when you look at the post-acquisition accounting, I would say the life is pretty simple. And the way you can actually, keep a track in terms of this is, I always tell people that under equity method of accounting, you can use your two hands and you can easily decide the post-acquisition accounting. Now, what do you need to do? Let's say this is the investment. That is the investor made in the investee. So this is the investment, and this is the net assets of the investee, the associate. So you've got investments on one hand, and you've got the net assets of the investee associate on one hand. If the net assets of the investee goes up, you need to enhance the value of the investment. If the net assets of the associate goes down, you need to bring down the value of investment. So you need to capture the changes in the movement of the net assets. So what do you need to do? You need to basically consider investment on one hand, and you need to compare the net assets of the investee at the other hand. So what you need to continuously track is look at the investment and look at the net assets. If the net asset goes up, you need to increase the value of the investment by the share in that increase. So if the net assets of the associate company goes up, you will increase the investment value to the extent of share in that increase. So this increase, you increase the investment to the extent of share. And vice versa, if the value of the net asset goes down, you need to bring down the value of the investment as well. So what is the journal entry which we are going to pass in terms of this accounting? So this is the basic principle which you need to follow. So when you're doing the accounting as far as investment is concerned, just visualize if the associate equity or the net asset goes up, investment goes up to the extent of share. If the net assets or the equity goes down, the investment goes down to the extent of share of the investor. And the most important part is, what is the journal entry to be done? What is the journal entry which we need to pass in terms of post-acquisition accounting? That is a very basic thumb rule. As an investee, if you're taking a credit to P&L, he will also take a credit to P&L. If he takes a credit to the OCI, you're also going to take a credit to the OCI. He takes a debit to the P&L, you're going to take a debit to the P&L. He takes a debit to the OCI, you need to take a debit to the OCI. If he takes a direct input in terms of SOKI, you would also take a direct credit in terms of SOKI, which means that when you're looking at this journal entry, you need to be careful in terms of what the associate company does. And accordingly, the investor would also do the same thing. So you need to remember some basic principles in this case. As an associate, if you are going to debit or credit the profit and loss account, he will correspondingly credit or debit the profit and loss account. That's the golden rule. So his debit is his credit, his credit is his debit. Similarly, you can say if he's got a debit or a credit to OCI, he is going to give a corresponding credit or debit to the other comprehensive income. So this is same, P&L is P&L, OCI is OCI, the debits, the credits, and the debits. Oh, sorry, my mistake. So his debit is going to be debit and credit. His debit and credit is same. So this is same. You need to follow the same sequence itself. He debits the P&L, debit the P&L, credits the P&L, credit the P&L, debits the OCI, debit the OCI. But this will be only to the extent of, you can say, share. And number three, we can say that if he takes a hit in terms of equity, that is SOKI. There is a wonderful illustration in this case. He is also going to take a direct hit in terms of SOKI itself. There is a particular illustration which is given in the study material, and that particular illustration is also there in the education material as well. which beautifully illustrates the accounting that as an associate, if you took a direct hit in the equity, you took an increase in the equity, the corresponding accounting in the books of the investor is also that you will take equity. So where does the other aspect goes? You take a debit credit to the P&L or to the OCI, then where does the other aspect goes? Investment account. The other aspect is going to be investment. So the entry in this case is P&L debit, investment credit. Investment debit, P&L credit. So he just needs to do what we technically call a one-line consolidation. So let me consolidate the picture once again in terms of the second issue. How does the accounting for an associate using equity method is done? So let's have a little quick consolidation of the concept. If you look at the standards in terms of consolidation, I guess the complicated part of the standard is more like 103 and Ind AS 110. If you look at 111, also slightly okay. 28 is pretty easy. 27 is also very easy indeed. Because once you get the hang in terms of equity method under 28, the life is very simple. So let's, I think, consolidate the picture under equity method of accounting before we'll take a small little illustration on the application. So number one, when you look at the equity method of accounting, I would say that there are two things which you need to take care. The stage number one is the initial recognition. In terms of initial recognition, it's a simple comparison of what you paid, the cost of the investment, vis-a-vis the share in the net assets at a fair value on the date of acquisition. You get the difference as a goodwill capital reserve, which is not reflected as a separate line item in the balance sheet, but it is going to be shown as a part of the carrying value of the investment. So this goodwill capital reserve computed is simply going to be a subject matter of disclosure as a part of the inner value of the investment in the balance sheet. Unlike Ind AS 110, where you are going to show this goodwill as a separate line item, in terms of Ind AS 28, this goodwill does not appear as a separate line item, but a part of the carrying value. That's one. Second, we look at the stage two, which is a post-acquisition, and you just need to give a basic principle. You need to follow a mirror image accounting in the books of the investor. Investee takes a credit to P&L, I'll take a credit to P&L to the extent of share. If he takes a P&L, I take a P&L. If he takes a OCI, I take a OCI. If he takes a equity, I take a equity, but to the extent of the share in the increase or decrease. So his increase is my increase, his decrease is my decrease to the extent of the share. And that's what I illustrated out here, that if he takes a debit credit to P&L, I take a P&L, OCI, OCI, equity, equity. And the other corresponding hit is going to be taken in terms of investment. And you know what? I made this mention in the detailed lectures as well. And I think I'd like to put that point here as well. Trust me, at any point of time, if you want to make a cross check regarding the investment value, trust me, you can do a small little cross check, and that is the investment at any point of time. That's a very strong statement which I'm making. Trust me, the investment at any point of time is going to be appearing at the share in the net assets of the associate plus the goodwill identified on initial recognition. You want to cross-verify the figure of the investment which appears in the consolidated balance sheet, pick up the net assets of the associate company as on that particular date, calculate the share in the net assets on that date, add the goodwill identified on initial recognition. Trust me, this is going to be the value of the investment. I think let's take a simple example on this particular concept so that then we can, I think, quickly go on to the appendix portion. We have covered that in detail. That's takes a long time in terms of third issue. So let's take an illustration and then we'll quickly give you a chart on the Ind AS 27 at the end. So first, let's take a simple question on the application of the equity method of accounting. So I guess I'm going to take a small little example which is given in the study material or maybe some examination question itself. I'll just give you a reference of that question and we can just make that particular input. That question Osoki, which I mentioned, also came in November 2020 examination as well. So maybe you can try that particular question also. Just a second. Let me just, I think, take a small little question on the application of the equity method. Let's take a question which came in January 21 in the exams, just to have a basic input in terms of things. This is January 21. There was an examination question on the application of this equity method. Though it was just for 5 marks, I think in this 28 questions are pretty simple and straight. So weightage was just 5 marks in the exam. So let me just give you quick inputs on that and we'll just solve it. It says on 1st April 19, Big got a 35% stake in Dig. So we give it that big company has got a stake in Dig and that is 35%, making it a case of a significant influence. That was on 1st April 19. Then it says the cost of this investment is 3 lakh and Dig had net assets on that date, which is 550. And the fair value of those net assets is 650. So we are given on this particular date the cost of the investment, and we given the net assets at a book value, and we given the net assets at a fair value. So we given the cost of the investment is equal to 3 lakhs. And we given the status of the net assets. The net assets at a book value is to the extent of 5.5 lakhs. And the net assets at a fair value is supposed to be 6.5 lakhs. And they also made mention that this 6.5 lakhs is due to a property, plant, equipment, which is being taken at more than the fair value. So this increase is due to property, plant, equipment, whose fair value is greater than the book value by 1 lakh rupee. So this is the status given. So this book value and this fair value differs by 1 lakh. So this is due to a property, plant, equipment taken at a fair value. And the life of this property, plant, equipment is 8 years. So we need to be careful on the depreciation aspect. Then he says for the financial year 1920, so I am given for the year 1920, there has been some profits made. And I'm given the profits made on this particular company is to the extent of 1 lakh. And we're also given the inputs that there is a dividend which is paid. So there is a dividend which is paid to the extent of 11,000. So this is the profits made by the investee for 1920. And this is the dividends which is paid for the year. And then it says D also recognized a remeasurement defined benefit in OCI. So he's also taken something in the other comprehensive income on account of Ind AS 19, that is remeasurement of defined benefit plans. And this is a loss to the extent of 15,000. So these are the basic facts which are given to us in the question. This is the stake of the percentage and the date. That is the cost, the book value, the net assets, and the fair value. Then we're given the profits earned during the year, and we're also given dividends paid, and there is something in OCI. So this is, you can say, profit and loss, and this is what you can say is in the OCI. Now, we were required to calculate the value of the investment on March 2020 in the consolidated balance sheet. So let's begin with the 2 stages of accounting. So I would say if I look at the first stage of accounting, the first stage of accounting is supposed to be the initial recognition, where you need to identify the goodwill or the capital reserve at the time of acquisition. So we will compare the cost of the investment. So we can compare the cost of the investment is 3 lakh, and we need to consider the share in the net assets. at a fair value. So we compare 35% of 6.5. So 6.5 into 35% compared to 3 lakhs, this is coming to a total of 72,500 is the difference. So that is coming to 72,500. That is the difference. So this can be called as goodwill. So we compare the fair value of these investments. We've got a 35% stake compared to the cost of the investment. 72,500 is the goodwill. If I were to make a balance sheet on this date, the investment would appear at 3 lakhs, and in the inner column, you would reflect a goodwill of 72,500 as a part of the carrying value of the investment. Then we come to the stage number 2. Then we come to the stage number 2, where we're going to consider the post-acquisition changes in this particular case. Now, here, as I said, we are going to consider the post-acquisition movements. If the associate profit goes up, P&L credit. The associate profit goes up due to OCI credit, and vice versa. So we're going to consider the base as the initial cost, which is 3 lakhs. Now we can see, number 1, there is a profit. Number 2, there is a dividend. And number 3, there is OCI. But there is one simple thing which you should always be careful when you apply the equity method of accounting. This profit of 1 lakh rupees is in the separate financials, or you can say the standalone financials of the associate company. Now we know that when he would have taken these profits, he would have taken the depreciation based on the book value of PPE. Because this fair valuation of the PPE is taken only for the point of view of consolidation. So the associate company in its own standalone financials would have taken a depreciation based on the book value of the asset. Now, since we are looking at a consolidated financials, this increase of 1 lakh rupee is also to be depreciated over the remaining life of 8 years. So when you consider the profit share, you should consider the share in profits based on the rectified profits and not the reported profits. So what are we going to do in this particular case? When you add the share in profits, we will say 1 lakh. That is the profits. There is an increase of 1 lakh rupees difference in the book value and the fair value, and there will be an additional depreciation. The life of the asset is 8 years. So from this profit of 1 lakh rupees, you got to reduce the additional depreciation due to a fair value change. So this 1 lakh rupees spread over 8 years comes to 12,500, and we will consider 35% of this rectified profits into account. So 35% of this comes to 30,625. This is the share in the rectified profits of the company, that is 30,625. So remember, this is reported profits, and we need to consider the rectified profits, which is post the depreciation. So we will make a reduction in terms of the additional depreciations for all those assets whose fair value has exceeded the book value. And if it is the other way around, you need to add back the excess depreciations as well. Next, we can say that there is a dividend paid. So the moment the asset company earns a profit, the net assets goes up. The investor pushes the investment. The moment he pays a dividend, we can say the net asset goes down and the investment goes down. So when this dividend of 11,000 is to be accounted, we reduce the investment value to the extent of share in the dividend. So out of that 11,000, 35% would mean 3,850. And finally, we are also given the inputs in terms of OCI losses, actuarial losses. The actuarial losses would push down, you can say, the net assets of the associate. Investor will also push it down. So we will also make a reduction in terms of OCI share, and that is 15,000 into 35%. It's a loss, so we need to make a reduction in this case as well. So 35% of this would mean 5,250. So this will give us the value of the investment, which would appear in the balance sheet. So 3 lakh plus 30625 minus 3850 minus 5250. So this is 321,525 is the value of the investment in the consolidated balance sheet at the year end. So this was a second phase of discussions. If I take you back out here, so we've seen the inputs in terms of the associate, the three issues what we discussed. Let me just come back to the chain out here. So I think we've done a discussions on the issue number one, the assessment of the segment influence with the application of para number 18 and 19. We've also seen the application of the equity method. Now, this is one area which was pretty long, so we've taken that in detail in the detailed lectures where we've covered the aspect of this appendix or the long-term interest. So you can refer that huge illustration which is given in the study material. It's been covered in detail in the previous lectures, which you can watch, and you'll see the complete illustration. I've solved it out there. Now, coming to the last area of our discussions for the day, and that is Ind AS 27. Few quick inputs to be given to you at this stage are Ind AS 111 done, Ind AS 28 done. Now, just a few little inputs on Ind AS 27. So let's come to the last phase of discussion, that is Ind AS 27. Which talks of SFS, that is called a separate financial statements. SFS, that is called a separate financial statements. Now, some crucial points which I like to tell you, which I made a mention earlier as well, but I think few things, two, three things which are worth making a mention at this particular stage. Number one, when I look at Ind AS 27, I would say it applies. It applies only if you've got related party investments. It applies only when you've got related party investments, but we need to be careful. I would say if you look at related party investments, it could be in a subsidiary, it could be in a joint venture, it could be in an associate, or it could be in a joint operation as well. But as I made a mention earlier as well, it is applicable to a subsidiary, it is applicable to a JV and associate, but this Ind AS does not apply to a joint operation. We've already seen the chart in Ind AS 111 that as far as a joint operation is concerned, you need to apply Ind AS 111 in this particular case. So even when you're accounting for a separate financial statements, in this case, Ind AS 111 would apply. So only three related parties where Ind AS 27 would apply. You've got investment in associate, JV, or a subsidiary, not a joint operation. That is one. The second input, what we need to be careful on. The second input, what we need to be careful on in terms of Ind AS 27. When you look at Ind AS 27, it says the investments in the balance sheet can be recorded at either a cost model or it can be taken at a fair value model. So the company gets an accounting policy choice in terms of recording the investment either using a cost model or in terms of applying a fair value model. Now, the question, the interesting part is when you're looking at a fair value, you are back to Ind AS 109. If you're looking at a fair value, you're back to Ind AS 109, where you would be accounting the investment either at FPTPL or it will be FPT-OCI, no recycling. Because equity investments are always taken at a no recycling and debt investments are taken at a recycling. So the moment you choose under Ind AS 27 to consider a fair value approach of accounting, you are going to go to Ind AS 109 and consider FPTPL or FPT-OCI-NR, whatever you choose. Now, another interesting point at this particular stage, very interesting indeed. Now, when you are considering the investment at a cost model, remember this is subject to impairment testing. Remember, this is subject to impairment testing as well. So the moment you carry these investments in related parties at a cost, you need to consider impairment testing, and this is not under Ind AS 109 because these related party investments are being excluded out of 109. You need to remember this subject to impairment is under Ind AS 36. And if you're going to consider these investments at a fair value, in this particular cases, no impairment testing. Equity investments at FPTPL or equity investments at FPT and are not subject to impairment. So they are not subject to impairment testing. They are not subject to impairment testing. So these investments are not impairment tested. So depending upon the kind of accounting policy, your triggering points in terms of impairment or no impairment testing would also trigger in this particular case. Next important agenda. Now, this is connected with the second one only, so I'll just like to make it separately. Let's say, for example, a company is got, let's say the company is got investment in an associate, in a subsidiary, in a JV. Can I choose a different accounting policy for a subsidiary? Let's take investments in subsidiary at cost. Let's take investments in associate at a fair value. You can. So you can choose it for each category. We can choose this option. We can choose this option for each category of investment. We can choose this for each category of investments which we made. So you can, of course, you cannot do that, if you've got 5 subsidiaries and you plan to choose a fair value for one subsidiary and you plan to choose a cost model for another. Subsidies will be taken at a same valuation model, all subsidies at cost or all subsidies at fair value, but different categories of investments. Associates could be one model, subsidies could be another model, JVs could be another model. So these are certain crucial points what you need to keep in mind in terms of Ind AS 27. So this is the crux. So what I've given you is when you're looking at Ind AS 27, by the way, there are again 3 inputs coming in. Number one, you need to apply the standard in terms of related party investments. Only in terms of subsidiary, associate, JV, not GEO. Number two, when you carry these investments, you've got a choice of cost or a fair value model, which can be chosen category wise. If you choose a cost model, you're subject to impairment Ind AS 36. If you choose a fair value, you go to Ind AS 109 and the concept of impairment is not applicable. So this was a crux in terms of the inputs which are given on Ind AS 27. So that covers up all the 3 agendas and issues for the day. We've covered Ind AS 111, we've covered Ind AS 28, and we've covered Ind AS 27. Now you can see the plethora of all the consolidation standards done. 103, we start the journey, and then 110, then 111, and then 28 and 27, 5 standards on consolidation done. Now, my piece of advice is that, for any detailed inputs, refer to the previous lectures, but otherwise sit down and make a complete revision of questions which are given in the study material. Practice the questions from the past examination questions, RTPs, NL as well. You get a complete hold on the consolidation because consolidation is one of the most important chapters from the examination point of view. Invariably, you keep getting questions out of this particular block. I guess so far so good. Let me see if there are any pending questions to be answered. I guess no. Okay. So I think that brings us to the end of this entire consolidation standards as well. I think time to say goodbye to you. So that's all for the day. Thank you very much. Bye-bye and take care. Haji, thank you. Same to you. Bye-bye.